Hi, this is Benjamin Taylor of Break Financial Management. Today I'm going to talk about whether or not we're currently in a new bull market. And the best way to do that is to try and figure out if we've actually seen a market bottom. And there are a few tools I like to use to be able to tell whether or not that has happened. Hindsight is 20/20, so we'll be looking at what's happened over the past few weeks or few months. And what we want to see, or at least what I want to see, is a low price and measure that price as it relates in history. We want to see a low PE on the market. I'd like to see bond yields that are at least very close to dividend yields, and maybe a dividend yield that is actually higher than a bond yield. I want to see low margin accounts, and I'd like to see the VIX, which is a measure of volatility, be pretty high. So let's look at price first. As of November 20th last year, we saw the S&P 500 reach a level of 752. Now that represented a 52% decline over the previous high, which had been reached October of 2007. Only 3 other times in history has there been a greater decline of more than 52%. And the last one was in the 1930s, which was 54% in the late 30s. The one that was greater than that was the Great Depression era, and that was an 89% decline. So a 52% decline is pretty significant. Another way to look at it is the decline in the calendar year of 2008. In 183 years of data that we have, there's only been 2 other times when there have been declines greater than the 38.5% decline we saw in the S&P 500 last year. And again, you have to go back to the 1930s to see when those 2 instances occurred. Another thing is, technically speaking, we've actually been in a bull market because we've seen a return from that bottom of 752 of more than 20%, and that occurred December 8th of the end of last year, where the market reached 909. And we've backed off of that a little bit, but rarely, and I believe actually only one time since World War II have we revisited the bottom after a 20% advance. So just based on price alone is a good indicator that we've seen a market bottom. The next thing is evaluation of the market. Now, S&P has been measuring operating earnings, price to operating earnings, for the last 20 years. And over those 20 years, the price to operating earnings have averaged about 19.3 times earnings. The 752 figure that we saw last November, that PE measure was 11.5 times, the lowest it had ever been since they've been measuring over the last 20 years. And we can even go greater than that. A good measure that I like to use is generally called the Graham PE, named after Benjamin Graham. Ben Graham took the last 10 years of earnings, averaged them over that time, adjusted them for inflation, and compared the current price to that figure. So the Graham PE of the last 9 bear market bottoms has been 14.4 times earnings. Well, that 752 figure that we saw in November, the Graham PE was 12.3 times earnings. Once again, lower than your average previous 9 bear markets, and that covers a period of 50 years or more. And the next measure I'd like to look at is how dividend yields relate to what you can get in the bond market. Over the last 50 years, 10-year notes have outpaced 10-year yields, have outpaced what you can get as a dividend yield. But as of December, for the first time in 50 years, you saw the market's dividend yield outpace what you can get in the bond market. So that's a really good indicator that prices are very low. The next thing is margin accounts. Now, people use margin in a speculative manner. When things are going well, they want to borrow money, they want to buy more stocks. When things are going poorly, they want to sell, and margin calls are coming in, and people diminish their margin accounts. So the lower margin accounts are, the more it's an indicator that we've seen a bottom. Now we've seen over a period of about 18 months, margin accounts almost cut in half. In mid-2007, we saw margin accounts of about 381 billion. And as of November of last year, we saw that number drop to about 200 or 201 billion in margin accounts. So that's a good indicator that we've seen a bottom. And the last thing I like to look at is the Colby Volatility Index, short called the VIX, also called the Fear Index. Historically, if the Fear Index reached above 20, that meant that people were panicking, they were selling, and the market was being oversold. Well, the end of last year, we saw the VIX reach levels it had never reached before in its history. We saw the VIX reach up to 80, and it stayed in a level about 50 to 60 for weeks. So people were just selling hand over fist, regardless of the fundamentals of the company. So there was a lot of panic selling. So that's another indicator that we had a market bottom. So I've gotten through the five things. What we have is a low price, indicated by the severity of the drop in the market. We have low PEs. We have a dividend yield that's historically high versus bond yields. We haven't seen this situation in 50 years. We have margin accounts almost cut in half, and we have a VIX at unprecedented levels. So when I take those things all into account, I kind of feel like we've seen the bottom and we are in the midst of a new bull market.